Welcome to Conversations, a weekly audiocast featuring interviews with leading investment strategists and recognized financial professionals. Brought to you by the Market Technicians Association.
This is Conversations, the official MTA podcast series, and today's guest is Walter Deemer. According to Deemer, the stock market is the most humbling thing human beings have ever invented. Walter Deemer began his Wall Street career in 1963 as a Merrill Lynch research trainee. In 1964, he moved to their market analysis department where he worked directly under Bob Farrell, and he has been a full-time market analyst ever since. In 1966, Walter joined Psi Management and Research just before the initial offering of the Manhattan Fund. In 1970, he went to the Putnam Management Company in Boston, one of the most prestigious money management firms in the world at the time, and headed Putnam's market analysis department throughout the 10 years he worked there. For part of that time, Walter was a full member of the Putnam Investment Policy Committee, and he was promoted to Senior Vice President in 1976. Walter formed his own company, Deemer Technical Research Incorporated, in 1980, which has successfully offered his market strategies and insights to institutional clients since that time. Walter Deemer is a founding member and past president of the Market Technicians Association and is a founding member of the American Association of Professional Technical Analysts. Welcome to the program, Walter.
Hey, thank you, Lance. It's good to be here.
So after 40-plus years in the markets, you finally decided to semi-retire, travel, and take time to write. Are you calling me from your retirement home today?
Well, it's a retirement home on wheels. It's an RV, and we get out of Florida for a couple weeks every summer because it's so hot. So right now we are in Otto, North Carolina, at the world's only RV&D, which is a B&D for RVs, Oak Ridge Farm.
Well, thank you for breaking away to spend some time with us today. Now, this year you published a book called Deemer on Technical Analysis, which is filled with nuggets and stories. But a few years ago, you were quoted as saying, "Whenever you think you've got a key to Wall Street, somebody comes along and changes the locks." Was there any fear that putting your thoughts in hardcover might render these tools obsolete in the future? When you publish Deemer on Technical Analysis?
Well, yes and no. The actual indicators, there's a litany of wonderful indicators that don't work anymore in the book, and I did that just because I knew them and I loved them and I wanted to pay respect to them and their graves, such as the specialist short-selling ratio or the member firm short-selling ratio or the Fidelity sector fund cash ratio. But also the stock market is basically, it's a behavioral thing, so you're really on a long-term basis you're measuring psychology, and as Bob Farrell has observed, history never repeats, but human behavior does.
Well, that segues perfectly to my next question. You're clearly a student of sentiment and contrary opinion. Do you have a favorite tool that you use to measure the pulse of the masses? No one favorite tool. One that's been working well is hedge fund sentiment, which I use both the ISI, Investment Strategies people at Hyman's Group runs a hedge fund survey every week. And then Robin Carpenter up in New Hampshire has Carpenter Analytics, where he does some hedge fund work, and it tells you how fully invested hedge funds are. And regrettably, hedge funds are like everybody else, that they're most fully invested at the top and they're most skeptical at the bottom. As a contrarian, basically, I make a living by fading the crowd, and the crowd can be anywhere from the public to hedge funds to every fund manager at Putnam. When you were at Putnam, there was an aggressive fund manager named Ken Pash?
Ken Pash.
And you told a story about flying computers. Would you mind sharing that one with us?
Well, what happened, my office was right next door to his. He ran the Putnam Equity Funds, which was a very aggressive fund, and during the dark days of 19 1970, I think it was, either 1970 or 1974. There were a couple of dark days. But one afternoon, I'm sitting in my office, and I hear this terrible crash. And I went next door to see what terrible thing had happened. And he had thrown his quote machine, which in those days was just a big, bulky old quote-on, and he had thrown it into the wastepaper basket. He was so tired of looking at the quotes coming across it that he threw it away.
So that was, what was that a signal of?
That was a signal you're getting near the bottom. You know, when the quote machines go flying, and I guess these days when you throw your computer out the window, you're getting close to a bottom.
So it works on the masses, and it works on the individuals as well.
It does. Basically, all humans, we all put our pants on one leg at a time, even the ladies with their slacks. And so it doesn't matter whether you're hedge funds or mutual fund managers or the general public. Psychology is psychology.
I know at my firm in 2008 and 2009, one of the traders actually handed out hard hats to everybody. That was a pretty good sign we were getting close to the bottom as well.
Yeah, I mean, you get to know when it's a bottom, when terrible things happen. The problem is things are always darkest right before the dawn, but you don't know how dark they can get. So you get whatever your favorite oversold oscillator is, and it gets frighteningly oversold, and you say, it's been oversold this way only 4 times in the last 50 years, and then it gets even more oversold. So that is the problem with oscillators.
Mm-hmm.
It tells you you're oversold, but it doesn't tell you how oversold you're going to get before the bottom.
You have something called the law of perversity, which is a catchy name, that says the market will do whatever it has to do to embarrass the greatest number of investors to the greatest extent possible. What is the lesson to take away from that?
The lesson to take away from that is that one has to be humble in the market, whether you're day trading or you're a long-term investor. The market is out to make a fool of you. And what you have to do is try to, stay humble through all the moves. I do it this way. That every once in a while, I say to myself, I finally got this sucker figured out. I really finally have it figured out, and I sit back, I put my feet up on the desk and relax, and if I smoked a cigar, I would light up a cigar and puff contentedly, and then inevitably, I get my head handed to me afterwards. It's just whatever you get comfortable with something, the market does something else. And of course, the market being a contrary beast, it's always going against the prevailing wisdom, whether it be on financial television or in the financial media or on blogs, that people are going to be telling you reasons why the market looks good after it's already gone up, and people will always be telling you reasons why the market looks bad when it's already gone down. So you're always leaning against the prevailing wisdom. Market technicians are very, very strong individuals. They're always going against the prevailing wisdom, and it takes a certain kind of person, a very special kind of person, to do that.
John Bollinger tells a great story. He says there's a fable from the trading pits in Chicago, and it suggests that there is a god who rules the pits, and the god has 2 rules. You may buy the bottom tick once in your life, and you may sell the top tick once in your life. And of course, by implication, you are free to do the opposite as often as you'd like. And in your book, you talk a lot about...
I have to interrupt because this gives me great hope, because I've been doing this since 1963, and I've never sold the top tick yet. So I guess I have a long life ahead of me.
I hope so. But in your book, you talk a lot about market tops and bottoms, and some of the things that you say is don't try to catch the exact top and bottom. So you're telling me that in the remainder of your career, you will attempt to do that.
Well, the thing is that a market top, as everybody in the MTA well knows, market tops are usually big, broad, drawn-out affairs, and certain areas can top out a year ahead of the market averages, and some areas can top out well after the market averages. So it depends on what area of the market you're doing. But usually tops are long, drawn-out affairs. Bottoms are usually pretty emotional, especially long-term bottoms. And the problem, as I said, with oscillators is you know things are going to look very bleak at the bottom, but you don't know just how bleak. So if you miss that first primary low, you inevitably get a test of that low, and that's a much safer buying opportunity, even though it's at a higher level, because you know then that the things are bad, but now they're starting to look better, especially on some of the technical indicators. They, of course, will look worse in the media because that's always the way it is, and then they will stay worse as the market turns back up and climbs the wall of worry.
You talk about bottoms being very scary things, and that when the time comes to buy that you won't want to. Are there specific ingredients that you look for in those buying opportunities? You talked about that second test of the low. What other things do you look for? And flying computers.
And flying computers. Usually, you know that you're in a bottom area. The trouble is picking the bottom, and it's like in 2008, you missed the bottom by 2 weeks. Well, that was a zillion%, because the market did a lot in those last 2 weeks. But you know it's a bottom. You just are well aware that it's a bottom, and then it's trying to time, and then you're also trying to look for things to buy. This is why, for instance, that you look for relative strength to develop during in individual stocks and groups during the late stages of the bear market and during a testing process, and then the concept of buying new all-time highs when the market starts up, because that tells you where the leadership of the next bull market is, because any stock that makes a new all-time high relatively early in a new bull market has done a couple of things very, very nicely. It hasn't gone down that much because it's close enough to its old all-time high to get there, and then it's been strong enough to get back up to and through that high. So you're doing long-term relative strength with one easy analysis. And there's a website that I mentioned in the book, and I forget exactly what it is, but it's nice enough to list every day all the stocks that make new all-time highs. So you do long-term relative strength analysis in the early stages of a move with one click of a mouse.
Let's switch gears to cycles. You mentioned several cycles, some longer term, but one of the shorter term cycles, you mentioned the 4-year cycle versus the presidential cycle. And you say that the 4-year cycle is a real phenomenon, but the presidential cycle is not. Can you talk more about that?
Well, the presidential cycle is Machiavellian in its derivation. What it says is that the Federal Reserve and the president are sitting in a room somewhere, and they want to get the president reelected after 4 years, or the party in power after the first 4 years. So right before the election, they stimulate like crazy so that the voters, who supposedly have a memory attention span of no more than 2 months, which may be fairly optimistic in this case, go to the polls feeling economically wonderful and saying that I owe all my good fortune to the party in power in the White House, and therefore I will vote to reelect that party. The Federal Reserve, then having stimulated as soon as the presidential party gets reelected, then steps on the brakes, and so the economy and the stock market don't do well in the first 2 years after the election. So basically, the 2 years after a presidential election are supposed to be lousy, and the 2 years just before the presidential election are supposed to be great. And that means that, of course, going back to the very last time this happened, that the 2 years before the election were 2007 and 2008. And for most investors, 2008 was not a particularly good year. So I don't think, and then, of course, 2009 was supposed to be a bad year, and it turned out to be a vintage year. So I don't think the presidential cycle works. I think it worked because it was overlaid with the 4-year cycle. And I think the 4-year cycle, which goes way, way back, is really a behavioral cycle. And what it says, in essence, is the swing from great pessimism at a bottom to great optimism at the top, It's a behavioral cycle, and it takes about 4 years to run its course. So everybody is frightfully bullish. The market corrects. They turned up getting frightfully bearish at a bottom, and it takes them a couple of years to regain that optimism, and then you go through it all again. As Bob Farrell says, history never repeats, but human behavior does.
Mm-hmm. So we had our last 4-year cycle low in March 2009, and I have 2 master's degrees, but I'm going to look to you to help me with the math. We'd be looking for our next 4-year cycle low early next year?
Yeah, first or second quarter of next year, all other things being equal, with, of course, the caveat that in everything in life, nothing is perfect. There are 3 prior instances of the 4-year cycle being extended beyond 4 years. In 1957, the market made a low, the so-called Sputnik low, and so the next low was supposed to be in 1961, but the market made a high, the Dow Jones made a high in December of 1961 when it was supposed to be making a low. And what happened was you pushed that 4-year cycle low back, and in 1962 you went from a high of 735 to a low of 525 on the Dow Jones. So it made up for lost time. Then the secular bull market began in 1982. The next low was supposed to be in 1986, but it didn't make a low. It didn't make a low. It made a high in 1987, and then you had the 1987 decline where you went from round numbers 2,700 to 1,800 in the Dow. So again, it made up for lost time. And then most recently, you had a 4-year cycle low in 2002, 2003. So you were supposed to have another one in 2007. Instead, you made a high, but again, then you were followed by a decline in 2008, which made up for lost time. So the problem is, if you don't make a 4-year cycle low on schedule, if you push it back, in this case, beyond the first half of 2013, the implication is the excesses have more time to build up, and therefore there are more of them to be corrected, and the ensuing correction is nastier than usual. So, going beyond the 4-year cycle, the normal 4-year cycle low, isn't really good news.
Mm-hmm. And so your typical tolerance is...
caveat in case somebody is listening to this in April of 2013, and the market did not make a 4-year cycle low, and I get more hate mail.
But your typical tolerance is roughly plus or minus 3 months for the cycle low, and if it goes beyond that, that's when you start getting nervous, saying if it's still going up, this isn't good news. We're going to make up for lost time, such as 2007, 8, and 9.
Right. And there's something somewhere on my website that we kept when I retired, or semi-retired, I kept some of the old things up, and there's an article somewhere on there called Bull Market Extensions, which I wrote in 2006 and 2007 that kind of goes into this.
And we already touched on this earlier, but I guess I'm coming at it from a different perspective on how do you confirm a low? So in late 2008, we're looking for a low from a 4-year cycle standpoint, and it looked like we got it, but then we came back down in March 2009 to even lower low. So from a 4-year cycle standpoint, is there a way to confirm that the low is in, or is this such a macro view that you're not really looking at it that way?
No, you confirm it, as in so many things, you anticipate it in real time, and then you confirm it later on, so that you can't really, at least I can't, bang on the table when the S&P hits 667 and say, this is the absolute low. And there are people that can do it, but they usually end up being embarrassed later on. So that the low is you anticipate a low in real time, and then you confirm it later on. The elements, let's put it this way, usually I say something to the effect like all the elements of a low are now in place. Now the market has to confirm by some upward action that it actually is.
Sure. Okay. What would you say is the best market call that you've ever made over your 40-year plus career?
It's hard to say, but the one I was proudest of was the one at Putnam in 1980, which was the Hunt Brothers silver crisis, when silver went up to $50 and then back down to $5, and there were all sorts of problems. And that I happen to remember it fondly because I was the special guest on Wall Street Week on February 29th of 1980, which is the only February 29th broadcast of Wall Street Week in its entire history, because that was a leap year. And I was kind of orchestrating the decline. That Lowry's oscillator was down into frightfully low territory, and you just knew that there was a major low coming. And that I started playing some games with memos that I was sending out with the Putnam money managers. And I started out by saying, they say the opera ain't over till the fat lady sings. So the first memo was the fat lady is waiting in the wings. And then as we got closer, the fat lady has come out on stage. And then finally, right at the bottom, I missed it by a day, the fat lady is singing. And and I remember that because the next morning I had come in. This was the day of the big reversal, and I remember coming in, and the big boss hauled me into his office, and he said, "Did you see the trading sheets from yesterday?" And I knew that I had better go like a turtle into my shell, so I said, "No, sir." And he said, "Do you know what those guys did yesterday?" I said, "No, sir." He said, "They bought 750,000 shares of stock on balance." Oh, this total volume was 9 million shares. This was a lot of stock. I said, "Oh," and he said, "They have never bought the bottom, that much stock at the bottom ever." And I looked, I sort of just went back and I said, number one is my orchestration had worked because I had given them the confidence to buy into a falling market, into a primary low. But the other was, this was a big boss. He was getting all the big bucks. He was running the investment division, and he never got his fund managers to buy at the bottom. This is not a very good testimonial as to his leadership. So my decision to go out on my own, I thought, was reinforced mightily at that point.
Well, we are out of time. Is there anything you'd like to add before we go?
No, this has been wonderful, and that the only thing I would add is that other than I hope that people might someday either buy or get the book out of the library that I wrote, that it is available on Amazon, but it's available in real bookstores too. One real bookstore had a sign on the window that says, "No public restrooms, try Amazon." So, and the other is that the stock market, as you said at the top of this, is the most humbling creation mankind has ever created, and that we who operated in it, who have operated in it for a long time, know full well how humbling it is, and it's just something you have to take. And the final thing is that market technicians are very special people. It takes a very special type of person to be able to go against prevailing wisdom and be able to do what we do. And I appreciate your letting me share my thoughts with some of the very finest people in the world.
Well, it's been a pleasure. The book is Deemer on Technical Analysis, Expert Insights on Timing the Market and Profiting in the Long Run. Today's guest has been Walter Deemer, and that concludes today's MTA podcast. From LexingtonCapitalLLC.com, I'm Lance McDonald, together with recording engineer Shane Swarek at the MTA, reminding you that price is always right.